Property taxes are on the rise in many parts of the United States. They're up 23% nationwide from 2019 to 2023. It's a huge issue in areas with high real estate values, particularly those near major cities.
This was not just the big bad blue states like New York and California and New Jersey. States like Florida, states like Texas will realize this applies to them too.
Congress's new tax and spending bill tackles this problem head-on, an increased deduction for state and local taxes. The tax break is expected to primarily benefit wealthier families. The biggest winners are in metro areas like the California coast, central Colorado, the DMV, and greater New York.
There is, I think, a disconnect when it comes to the perception of this cap, precisely because it is being levied on higher-earning folks who live in high cost of living states with high property values.
The fight over this deduction is long-running and transcends party lines. Lawmakers call them SALT deductions for short.
For these families who are just getting by, the SALT deduction can be the difference between saving for a child's college education or having enough savings to deal with an unexpected emergency.
That said, this policy has its critics.
We should not have to pay to make up for the rich folks in New York who are getting raped by their local and state governments.
We asked local lawmakers representing the New York metro area, including Mr. Salt himself, why Congress raised the SALT cap. States like New York have a notably high cost of living compared to other parts of the country. It's a huge issue in areas like Westchester County. Here, the typical home sells for nearly $900,000.
We have so many people that have had their families and they were able to buy a home, and they bought that house maybe $100,000, $150,000, $200,000 maximum. That same house now is worth $600,000, $700,000, or $800,000 depending on the community. And they didn't do anything but live in the community.
The price increases mean many homeowners are house poor, meaning they're spending a significant chunk of their income on property taxes. The state and local tax deduction lets families lower their federal taxable income by the amount of money they already paid to state government and local government. That includes state income tax, sales tax, and property tax. Those expenses fund public services like roads and schools.
And those taxes were fully deductible, and that took care of roads, bridges, school districts, etc. And that's why we had so many good things that are happening from an infrastructure perspective in the state of New York.
Until 2017, Americans could count up these local taxes, then deduct them from their taxable federal income. The so-called One Big Beautiful Bill made taking this deduction more attractive to families who bring in less than $500,000 per year. The state and local tax deduction was initially put in place to cut down on double taxation.
So this was in effect for over 100 years prior to the 2017 passage of the Tax Cuts and Jobs Act.
Prior to 2017, it was unlimited. All dollars taxed by state and local governments weren't subject to federal tax. That ended in 2017 when Congress capped the deduction at $10,000. The effects were most noticeable for people who itemize their taxes. Itemizing involves adding up all of your potential tax breaks. If the amount is greater than the standard deduction, you can save money when filing.
You only get the benefit of the state and local tax deduction if you are itemizing. Right now, only about 9% of filers itemize, meaning over 90%, 9 in 10 Americans who are filing their taxes are not getting any benefit from the state and local tax deduction.
This 2017 policy change meant that taxes went up for many people who itemize.
It was very negative for so many people. Most places in Westchester County, that is not covering the amount of property tax that you were already paying.
The cap was set to expire at the end of 2025 and return to being unlimited.
A lot of people will say, well, SALT was going to become unlimited. Why would you agree to a cap? If the Tax Cuts and Jobs Act expired, you would have had the standard deduction cut in half, which would have been a massive tax increase on almost every American. So we had to look at this in totality of all of the provisions of the tax bill, not just SALT by itself.
Households making $1 million or more got most of the savings from the previously unlimited deduction. But Republicans in Congress say they want tax policy to benefit the middle class.
We wrote this bill for the lower and middle class earners in America.
To achieve this, the law shrinks deductions for very high-income families. The cap gets incrementally smaller for those making over $500,000 a year.
While the income level may seem high, in comparison to what the cost of living is, it really isn't. And so when you get hammered with these property taxes and state income taxes combined, and then you get basically double taxed on your federal income tax return because you can't deduct it, that creates a real problem.
Thank you, Mike. Look good. Mike Lawler, Mr. Salt. Well, it should guarantee your district.
Many lawmakers were against raising the SALT tax cap at all. The core critique? States like New York have mismanaged their spending, which led to today's high tax rates. In 2022, New York had the highest state and local taxes. That year, they were also number 2 in spending.
Why the hell should I subsidize their stupid decisions in their states for their expensive taxes? Why should my constituents have to do that?
Whenever someone suggests that there's government being frivolous or services that are being expended on people that shouldn't have those services, we explain to those folks that they really need to get on the ground and get out of Washington. They're not seeing everyday life the way that most people have to see it.
Democrats and Republicans from lower tax areas of the country argued that the cap's increase was effectively a tax on their constituents. That's because raising the cap on deductions ultimately reduces the amount of revenue the government takes in, driving up the debt, which even Lawler acknowledged is an issue.
We are running $2 trillion deficits on an annual basis. We're paying $1 trillion in interest to service that debt. So we have a real challenge. And as a country, both parties need to get serious about dealing with this.
The $40,000 cap in the 2025 tax bill is projected to increase the national debt by more than $142 billion over the next decade, according to the Joint Committee on Taxation. Other groups have even higher estimates.
The state of our debt has impacts on everyday folks every single day. If investors have less confidence that we're going to be able to pay back our debt in the long run, they're going to be requiring a higher rate of return. So what that means is often the rates that you basically for car loans may go up. 30-year mortgage rates that are conforming might go up.
Lawmakers made one more change to SALT to keep the cost low. That $40,000 cap expires at the end of 2029 and reverts back to $10,000.
To the populace and to voters, these things are permanent. You can't take them away, otherwise it's a tax increase. But for the accounting purposes, both in 2017 and now, they're all temporary and they're all going to go back. It's never going to go back.
That means Congress might have to take up the battle for SALT once again.
So these states, as they see their tax burden go up, they have more expenses, they need more law enforcement, they need more teachers. I think, we'll be able to win that fight again.